Hello and welcome back to our channel where we talk all things finance. In today's video, we'll be diving deep into the topic of whether the Federal Reserve will raise interest rates and what that could mean for the economy and your personal finances. The Federal Reserve's decision on interest rates can have far-reaching effects on various aspects of the economy, from borrowing costs to investments and savings. So, let's take a closer look at this important topic. Let's start by understanding the role of the Federal Reserve in the economy. The Federal Reserve is the central bank of the United States and is responsible for implementing monetary policy. One of the key tools the Federal Reserve uses to control the economy is interest rates. They can raise or lower interest rates to influence borrowing costs, spending, and investment. Over the past year, interest rates have been at historically low levels due to the economic impact of the pandemic. However, as the economy has been recovering, there has been growing speculation about whether the Federal Reserve will raise interest rates to combat rising inflation. Inflation is the rate at which the general level of prices for goods and services is increasing. In recent months, there have been concerns about rising inflation, with prices of goods and services going up faster than anticipated. The Federal Reserve has a target inflation rate of 2%, but if inflation exceeds that level, it may prompt them to consider raising interest rates. There are several factors that the Federal Reserve considers when deciding whether to raise interest rates. They assess the overall health of the economy, including factors such as employment levels, GDP growth, consumer spending, and inflation trends. They also take into account global economic conditions as well as geopolitical events that may impact the economy. If the Federal Reserve does decide to raise interest rates, it is likely to be done gradually and in a measured manner to avoid causing any economic shocks. Small increases in interest rates can impact various aspects of the economy, such as borrowing costs for mortgages, auto loans, and credit cards. It can also impact investment decisions, such as bond yields and stock market performance, as well as savings and retirement accounts. It's important to note that the decision to raise interest rates is not without its risks. Higher interest rates can potentially slow down economic growth by reducing borrowing and spending, which may impact businesses and consumers alike. It can also have implications for the affordability of debt and the cost of servicing existing loans. In conclusion, the decision of whether the Federal Reserve will raise interest rates is a complex one that depends on various economic factors. As consumers, it's crucial to stay informed about the economy and be prepared for potential changes in interest rates that may impact borrowing costs, investments, and savings. We hope this video has provided you with a better understanding of the potential impacts of a decision to raise interest rates by the Federal Reserve. Thank you for watching, and don't forget to subscribe to our channel for more in-depth insights on finance and the economy.